Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, December 4th. So, last week concluded an amazing rally during the month of November. We had both fixed income and equities up in the US, and in particular the S&P 500 up over 9%, best November we've seen since 1980. And then on the fixed income side, the Bloomberg Aggregate Index was up 4.5% during the month. So what precipitated this? You might think it might be great economic data that came out, positive growth, or some stunning news on S&P 500 earnings, or possibly fiscal restraint coming out of Washington. But it was none of that. Actually, it's an increasing conviction by investors that things are going to get worse economically, enough so that the Federal Reserve is going to be forced to cut rates aggressively. So most of this is really not based on the fact that inflation has hit its target, because it hasn't. It has come down nicely, but as we'll see, the PCE, personal consumption expenditure, is still well above the Fed's target. But it does appear that investors are betting that what is going to be more important is that the timing of the impact of all these rate increases is still yet to come. And then over the next few months, we're going to see dramatically slower U.S. growth. And this comes on the heels of the third quarter, where we had surprisingly strong GDP growth of 4.9%. So we're a little bit concerned in that the huge rally that we've seen here in November, again, both equity and fixed income, it could become unwound very quickly if we see strong economic growth, stronger than expected, or if the Federal Reserve digs their heels in and claims that they will continue to increase rates or not decrease rates at a pace not consistent with market expectations. So I think we are at that stage where we've been many times in that positive economic data that comes out from going forward is not going to be viewed favorably by the markets. Conversely, weak economic data will actually be championed, will be welcomed by investors here in the U.S. So last week was definitely the case. We had economic data points that, I would say on average, were actually negative, but the markets were up, both equity and fixed income here in the U.S. So a lot of news last week. We'll go through it relatively quickly. But real estate prices, residential, the Case-Shiller index came out for the month of September. The expectation was it would be up 4% year over year. And I think going forward, this is going to roll over pretty hard. But the expectation was it would be up 4% year over year for September. It was up only 3.9%. So a bit of a positive there. Consumer confidence came out last Tuesday. Now this is the federal government's gauge, not University of Michigan. We already saw Michigan's came in way lower than expected, but the U.S. consumer confidence number did come in slightly better than expected. Expectations were it would come in at 100, came in at 102. Then on Thursday was the good/bad economic news. Personal income, personal spending, both were up 0.2% month over month, exactly where it was expected. But the money ball for the week really was PCE prices, personal consumption expenditure. As we've mentioned many times, this is the preferred gauge of inflation by the Federal Reserve for policy-making, decision-making purposes. And that was expected, PCE was expected to come in at a positive 0.1 for the month of October. Now, the month of September, that was a positive 0.4. So, again, it was expected to come in at a positive 0.1, actually came in flat, 0. So, very welcome sign for investors. PCE prices, core, taking out food and energy, came in exactly as expected at 0.2%. 0.2% is where it was expected, where it came in. So we would have to say that inflation, the metrics saw last week, very favorable for markets going forward. The last thing was ISM Manufacturing Index, which came out last Friday. This, as we mentioned, we believe, we'll just use the term, in a manufacturing recession. This indicator has been under 50, which is a demarcation line between contraction and expansion. It's been in the contraction territory now for 15 consecutive months, and it was expected to come in at 47.6, the actual 46.7. So, bad news again, kind of being rewarded at this point. Good news economically probably won't be tolerated. What this has done then is set up for the Fed meeting, which is next week. Next week, Wednesday, will be the announcement, the Open Market Committee. Expectations are 100, as close as you can get to a certainty there will not be an increase or decrease. There's 0.3% chance of a decrease, no expectation whatsoever of an increase. So that's pretty much baked in. We all know that. What is really interesting now is how aggressive investors have become with expectations of cuts during 2024. So if we look at December 2024, go 1 year ahead, there are 99.7% odds that we'll get a minimum of 50 basis points in cuts during 2024. So a certainty, as certain as you can get, betting-wise. So we're currently at that range of 525 to 550, so 99.7 expectation that goes down 50 basis points. But there's a 65% probability in we'll see at least 125 basis point of cuts from the Fed funds rate from where we're at currently. So in terms of GDP expectations, we always look to the Atlanta Federal Reserve to see what their updates have been. 2 weeks ago, they were 2%. They brought that down a week ago to 1.8%, and then last week took it down to 1.2%. So clearly, the Federal Reserve, Atlanta Federal Reserve, is seeing some signs in the economy of weakness, of slowing. Again, instead of being feared, this is something that investors are encouraged by most recently. So inflation expectations, that's continued to come down. I would say it's been about 2 months ago. It peaked for the year at about 2.5%. That's the 10-year Treasury minus 10-year tips. That has been coming down consistently since then, and now we're at a point where we're almost at the low for the year. The expectation for U.S. inflation over the next 10 years by this gauge is an average of 2.22%. So with all that last week, again, it was an amazing month of November for equity, for fixed income. We'll focus just on last week, which was positive for both metrics, particularly fixed income. But last week, S&P 500 up another 0.8%. Year-to-date through Friday, S&P up 21.5%. So last week, what worked in the U.S. markets, the thing that really stands out, small cap. So this has been contrary to what we've seen for most of this year. Large cap and particularly large growth has been leading the markets. Last week, we definitely got a very strong rotation to small cap, which is great for our clients as we do favor small caps. Small caps in the U.S., again, S&P 500 up 0.8%. Small caps up 3.4%. Internationally, also up, but as this is a recurring story this year, up as the U.S. market was, but a little less so than the U.S. market. The MSCI World ex-U.S. up 60 basis points. Emerging markets up less than that, 0.18%. And again, a picture we've seen many times this year. While the U.S. developed markets, emerging markets were up, China was down last week, down 2.6%. So China in total this year now down 12%, 12.1%. Again, juxtapose that versus the S&P 500 up 21.5%. So the big rally last week, fixed income. 2-year yields down 41 basis points. That's just an amazing number. The 10-year down 27 basis points. So the Bloomberg U.S. Aggregate Bond Index up 2.04% last week, now up 2.5% for the year. The big winner, as you might have guessed, U.S. long government bonds with that rally in the 10-year, that was up 3.6% on the week. So very strong week, fixed income, international, U.S., and in fixed income in the U.S. markets. So let's take a look at this week. Plenty of economic data coming out this week, not probably quite to the level of last week. We start off tomorrow with the ISM non-manufacturing or services index. while I mentioned we've been in a manufacturing recession, the ISM manufacturing has been below 50 for the last 15 months. ISM services has actually been quite strong, and I think only 1 month did it drop under 50 over the last 15 months. So the expectation for the November number, which will be released tomorrow morning, is it's going to come in actually better than it was in October. It's actually supposed to be up slightly to 52.4. On Thursday, we're looking for initial claims. Now, this number we follow from time to time and not fixated on it, but certainly the labor market is going to get a lot of focus going forward, particularly this week. We have the initial claims. The expectation is we'll have new claims of 223,000. The prior week was 218,000. But then on Friday, in terms of, again, labor and payroll numbers, we get the non-farm payroll numbers. This will be fascinating, at least for us. Last month, the month of October, was only 150,000 below expectations. It's expected to have been a positive 175,000 in November. That is a consensus. Wouldn't be surprised to see us miss that. But the thing that will also be interesting, and we don't usually show you the slide for this, but it definitely caught our attention. If you look at the revisions every month over the last year to the labor numbers for the prior month, and they actually do it for the month before, they've almost all been negative revisions. So the pattern has been the government reports great job numbers, and then the next month they walk them back, and the next month they walk it back further. Hard to get a really clear picture, but nonetheless, we'll be very focused on that number that comes out on Friday, non-farm payroll expectation, 175,000 new jobs for November. We'll also look at the average hourly earnings, expected to be 0.2%, up 0.2%, which is the same as we saw in October. The unemployment rate is expected to be unchanged as well. This number is pretty volatile. It has a lot to do with participation levels. Too many factors. We don't usually focus on it. You can get short-term aberrations, movements in the number that really don't make sense. Nonetheless, expectation for unemployment rate, 3.9% in November, same as we saw in October. And then the last data point that we'll see, again, this is consumer confidence, but it's the University of Michigan's version of it, consumer sentiment. The month of November, that came in at 61.3. That's expected to be up slightly for the month of November to 62.6. So that's it for the economic recap, and look forward at this week. Thank you very much for your attendance. Hope to see you next week. Thank you.